IT is the same as it is the same as debt to equity ratio, but it's a little different. But it drives a similar indication. So total debt ratio compare total debt to total capital. So it's kind of a debt to asset ratio. So how much debt did how much debt you're using relative to your asset? Yes, debt to equity. And how much debt relative to equity is debt to equity. So these two are interchangeable. They convey same meanings. Okay. So higher debt to assets or higher debt to equity means there are higher financial risk, higher financial leverage. They're using more debt. And financial risk can be also measured by its earnings or cash flows. So how much cash is available to meet the payments. So higher ratio means lower risk. Typical measure is the interest coverage. How much cash, how much profit, how much earnings do you make for a given period of time to pay off your debt? So income before interest and taxes, this is a operating profit before paying taxes. So in the income statement, there are sales and cost. So if you deduct cost, then you will get a gross profit. And if you deduct some operating cost, you will get a operating profit. Operating profit such as EBIT. This is called a earnings before interest and taxes because this profit is before paying the interest. So interest expenses is the non-operating cost that will be subtracted from the operating profit. So how much does the firm's earnings exceed its interest payments? So let's say this interest payment is a fixed cost you have to pay off every month or every quarter or every year. So if you earn higher profit or higher cash, you have more ability to pay your interest. So you won't get a default. So higher interest coverage ratio. So higher ratio, more stability and lower risk. And cash flow ratio can be simply calculated by adjusting its non-cash expenses such as depreciation and amortization. Deferred taxes also a non-cash expenses. So cash flow ratio it relates to the flow of cash available from operations to either interest expense and total fixed charges or the face value of outstanding debt. So how much does the firm's cash flow exceed its debt? So higher cash flow ratio, it means more financially stable. Okay, so you should have this deferred taxes is also a non-cash expense. Suppose you should have paid out a tax, but it's deferred. So it's kind of a debt because you have to pay it in the future. So overall, relative to that, how much operating cash? Operating cash, this is kind of a profit metric. So how much profit, how much operating cash did you generate relative to your debt? So higher the ratio, a higher stability. Okay, growth potentials. Creditors, debt holders are more interested in the firm's ability to pay future obligations than firm's growth potentials because they don't like risk. Okay, they don't like risk. They do not tend to take risk. While stockholders are more interested in the value of the firm, a stock price, which depends on its future earnings and future growth in earnings and dividends. But debt holders don't care about its earnings growth. They only need to get its money back. They are only interested in payments. So they don't like investment for future growth. To get more profit, firms have to invest in such as factories to manufacture more products so they can get more profit. But this is followed by some risk. This has some risk by itself. So creditors, debt holders doesn't like this investment. They don't like taking risk. So making more profit is only available to stockholders. More net income, 100% of net income will attributable to stockholders, where creditors will get a fixed amount, which is the interest payment. So they don't like investment for future growth. But as a stockholder like us, we have to analyze firm's growth potential because this earnings growth is closely related to a stock price. Fundamentally speaking, a firm's growth is determined by its investment and its profitability. So if they more invest in projects that are more profitable, they will grow more. Okay, so in the long term, the sustainable growth rate, so this is called sustainable or long-term growth rate. So in the long term, the sustainable growth rate is the retention rate times a return on equity. So if you retain more money to invest in the future, and if you multiply by your current profitability, a return on equity ratio, which shows your current efficiency and profitability on your equity, it shows your growth rate potential. Okay, from net income, net profit or net income, you either pay out dividends and you retain. You do not pay out this earnings, but you retain this net income for future investment. Okay, suppose your profitability, your return on equity is 10%. So if you pay out 60% of earnings, if you pay out dividends by 60% of your net incomes, and if you retain 40% of net incomes for future investment, it means that a 40% of your cash, 40% of your income can be used to reinvest at the rate of 10%. Okay, this retained earnings can be reinvest, your retained earnings. It's a concept that your retained earnings can be reinvested at the rate of a 10%, which is a return on equity ratio. So which in turn you will grow a 4%. So this 4% is your sustainable and long-term growth rate, which is a growth potential. Okay, to sum up, there were some internal liquidity ratio measured by a current ratio and quick ratio and cash ratio, and the operating performance or the efficiency ratios were measured by some profitability ratios such as net income, net profit margin, or return on equity. This financial risk was measured by debt to equity or debt to asset ratio. And this growth analysis, the growth potentials were measured by a sustainable growth rate. These financial ratios can be used to value your stock. So it can be used for stock valuation and for identification of corporate variables affecting a stock's beta. So beta is the market risk. Say how much your earnings structure will be changed, will be volatile relative to its market movement or economic situation. Or you can use this financial ratio such as debt to equity or debt to assets or profitability, return on equity, or your interest coverage ratio. This ratio can be used to analyze the firm's credit ratings. For bonds, there are some credit ratings such as AAA. It has lower default risk, and AA and single A and BBB or BB or B. So these credit ratings indicate firms a probability of default. So this is kind of a solvency credit ratings, and this ratio can also be used to predict your firm's probability likelihood of the firm's bankruptcy. For financial ratio, analyzing financial ratio have some limitations. Say accounting principles may vary among firms, especially among non-US firms, such as firms using IFRS versus US GAAPs. Firms may have division, and in addition, firms may have divisions operating in different industries, making it difficult to derive industry ratios. So let's say some firm has manufacturing operations such as IT, and at the same time they can either have some service such as internet softwares. In this case, analyzing financial ratio can have some difficulties to derive an industry average or industry ratios. And another limitation is that the financial statement, by their nature, are the historical numbers. So financial statement numbers are historical numbers. So they do not predict futures. Okay. So the efficient market will have already incorporate this past information into stock price. So why do we have to analyze the statement, right? But nonetheless, analyzing financial statements are important for several reasons. For instance, it provides a knowledge of a firm's operating and financial structure and helps estimating future performance. And how can we predict the future without analyzing the past? Okay, even though it's already reflected in the price. Okay. See you next week.